Welcome everybody, good evening. This is the Thursday evening Viper Trading webinar. If you're here to learn about trading the futures markets using the Viper tools, you're absolutely in the right place. First we got to knock the standard disclaimer out of the way, so let's do that right now. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar, other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everyone in here does know that you do trade at your own sole discretion. Okay, good. Welcome everybody. Tonight's topic is managing multiple contracts. So without further ado, let's get over to a chart. And I do have a question for the team here tonight as I switch to screen one. Stand by. All right, so just a quick poll of the group. How many contracts do you trade currently? This is a question for everyone here. How many contracts do you currently trade? 1, 2, 3, more, multiples, 5, 6? If you can, also type in, maybe what you trade. So 5 on YM, or 4 on NASDAQ, or 2 on the Russell, 3 on crude oil, whatever that is. Wow, many multiples. Look at this. Okay, so Brian trades 5, Michael P 4, 2 in Sim. Okay, 2 to 3 on YM and Russell for MG. Mindy's there with 2. Okay, good. Walter likes 3. Perfect. NASDAQ and crude. Okay, a lot of crude and NASDAQ combinations in here. Carl likes 2 on YM and NASI. And Jim does 3 on YM. Okay, perfect. Hey, if you're just coming in, don't worry. We're still getting started. The question we lobbed out there was how many contracts you trade and what instruments. 4 on YM and NASDAQ. Okay, good. All right, so what I want to show here is a little bit how these markets traded this morning. And then I will... well, that's the other thing. By the way, we're getting a final comment coming in here from David D saying that sometimes you can get clobbered with multiple contracts. And I'll check that, Mindy, when we switch to, she's asking about the rollover time on the contracts for the equities. We'll look that up before we wrap, Mindy. If you could please remind me of that before we wrap up here. I'll show you. In fact, I'll show you where you can bookmark that. Everybody can bookmark that, and you'll be able to check any time for that. Okay, so let's get right into it here. All right, so today here's NASDAQ, and let's go over to the open of the market. So the open was a little choppy until she really started to sell off. Oh, excuse me. Oh, my apologies. I'm sorry. I gotta drink some coffee and wake up here. Okay, so let me put a vertical line right where 630 is. So the open of the equity markets is right here. 6:30 Pacific time. Just translate that to your local time. Now, the thing that made this particularly confusing, here's probably the best way to phrase it. When I see that a market, so even before we talk about the concept of multiple contracts, and so let me just step back. Let me step back for a second. Start at the very scratch, so we're all clear and on the same page. That's what I'd like to do. Okay, so when I say multiples, in regards to my personal trading, I'm not talking about 1 or 2 or 3. 1 or 2 or 3 is what I scale back to from where I normally put like 8 or 10 or 12 on. So when I say I'm loading the boat means multiples, serious multiples, like 10 or more. And then so when we get long in the tooth in the morning where markets tend to get a little more choppy and we say something like cut it back, don't trade the multiples so much anymore, I'm really talking about cutting it back to 1 or 2. So just to talk about what that phrase means. Now for some of you, multiples could be 2. So just to clarify that. if you can trade 2 contracts, that would pretty much kind of be the minimum. You can trade one. If you want to trade one because you're live and you don't want to risk too much capital, that's perfectly fine. And I would suggest until you're comfortable, and this is a caveat I want to put in here real quick about all this, is that please, please, please do not try to rush yourself into too many multiples if you're not ready. You should have a very, very high win rate. Okay? Just for a second here. You got to have a very high win rate and a very low drawdown to think about leveraging up beyond 2, 3 contracts into 4, 5, 6 and more. Because you got to realize that when you start loading a boat like that, you know, look at it this way. You know, at $5 a tick, you put six contracts on NASDAQ. Now you're at $30 a tick. You take a 10, 12 tick pop. You know, you've lost what, 300, 350 bucks. Boom, one trade, boom. And I know a lot of you trade NASDAQ and YM because it's $5 a tick and you don't want to get hurt that badly. So all I'm trying to say here is that don't be afraid of multiple contracts. In fact, I suggest that everybody eventually sort of leverage up to those. But you have to realize that, you know, it can bite both ways. So just be ready before you really start leveraging up. The targets are really a function of what instrument and where the swings are, Brian, and I'm going to talk about that in just a second. Now, when I came in to look at this NASDAQ chart, it looks something like this. I think I came in, I usually come in, you know, a couple of 5 minutes before the open of the market, and I get all my charts sort of organized and see what the market's doing. So let me ask a question. Looks like we're heading down here. You know, right at the 6:30. Excuse me. Could be a big move here. You think we should go ahead and short this right now? Tomorrow morning, if we come in and market looks like this, I don't know. It looks like it's bottoming out. We should probably do a box right here and take the shorts, huh? What do you think? Anybody with me? Short in the market right here? Ooh, I don't see any answers. Good, good. I wouldn't. Too close to a bottom. No, no, no. Good, perfect. All right, yeah, now let me, interesting enough, Jim W. said this. It's pretty tempting. So here, what I want to address is the natural tendency, and you know what? 21 years of trading, and I still feel the same thing. It's just something. I think it's just a natural human thing or whatever. So background is red. Band stair stepping down. Looks like it wants to tank. The natural tendency is to say to yourself, man, I should jump in this short because it's going to tank. But the one thing we've always, and some of you have been in these webinars where I did this, where we all took a pinky swear and chanted together, we never ever go long or short the thrust move. So in this case here, for instance, you can see right at the open, we're thrusting downward, right? See it? So I think GW and a couple of you typed in a very, very good answer. I'm waiting for a mid-band retrace or a retracement of some kind. Perfect. That's exactly. We're not thrust traders. We are retracement traders. Yes? Perfect. Good. I want to just sort of throw that out there because when you start looking at something and it's already made a move, the natural tendency is to want to go ahead and take action. But we know we have to sit on our hands, patiently wait for a retrace, and then look for our entry. Good. Perfect. Just want to lob that out there. Okay, good. So here we come in. Now, you know, you can see that to the upside, and this is in the pre-market session. So here's 6:30. Here's the pre-market session. I don't know if I think we had some news at 5:30, and we got some resistance up here, right? And we got some support down here. More or less kind of down, well, down in this area. Anywhere kind of down in here. You got some support, and you could say resistance is just sort of right up in here. So from midnight last night over here at California time all the way up and through the pre-market into the live session, we are in a big old trading range, yes? I mean, just a big old trading range. And so I think we all would agree as long as we're in that range, that we're going to be looking for issues or potential spots to trade within the range, yes? Let me go ahead and advance the chart a little bit. I'm going to do it in like 10, 15 minute increments, and I'm going to talk a little bit about how we can manage this. Okay, here we go. I'm going to do something like this. I'm going to go ahead and show it come up. All right, look at what's happening here. We came in the first 2 to 3 minutes of the market, came up here, hit this swing, pulled back, checked the mid-band, came up, checked this swing again. It's really struggling to get up to the higher levels. It's not getting all the way back to here. And furthermore, I would submit to you that ranges adjust dynamically on the fly. So in other words, when you went into the pre-market session, this is what the range looked like. After a couple of 5 minutes into the open of the market, this is what the market looked like. Now you have support here. It's actually in a tighter range within the range. Everybody see that? It's pretty choppy. Yeah, pretty choppy. Now let me ask you a question. When considering multiple contracts, is this a condition where you should load it up for a bear? Yes or no? Are we loading for bear here? It's time to go ahead and put 8 or 10 on, load it up. What do you think? Okay, good. All right. Some good answers. No way, no, no. Reduce your exposure. Yeah. Okay, let me back up and explain something for a second. So the reason that the principle behind leverage is to leverage up in situations where you have a moving market, preferably a large moving market with a big trend. You get nice big swings, and you can see very clearly where to get in and get out. You know, it's hitting targets, it's pulling back, it's rolling over, and you got a nice big trend up or down. In my personal view, when trends start to unfold, that is the time to scale up. Think of it this way. It's kind of like putting, gasoline on a big fire. What's it going to do? It's going to explode and go, it's going to take off like a rocket, right? You want to fuel your ability to make money when the market is moving. And the reason for that is that where you want to, as Walter said, reduce your exposure, which essentially he's saying reduce your risk, which is true. That's exactly what we're doing, is that when you're trading in ranges like this, we all know, we've shown a million ranges in all these webinars, and we've talked about it till the cows come home, right? Everybody knows this. There's not a lot of money to be made in these ranges, first of all. There is a fair amount of risk, because if you're buying support, taking profit up here and shorting the top and getting in and out, at the end of this range, it's going to break out one direction or the other, yes? And when it does, usually that's when the stop out occurs, right? If you trade the range, we all know that, right? So think about it. If you're leveraged up to 10 contracts to the hilt and you get stopped out of a range like this, whatever money you've made cobbling together some trades in the middle of this range gets all wiped out and erased on the break. Right? Does everybody understand that? So think of it this way, very simple. Range, in my personal view, when ranges like this require reduced risk. Yeah, that's coming, Brian. You're kind of one step ahead of me tonight. He's saying, well, show us some spots where we should be loading up the boat. That's coming. We got to know how, we got to sort of understand the principle of leverage and when to apply it. So that's all I was trying to cover there. Let's advance the chart a little bit here and talk about what happens next. Hold on a second here. All right, we're coming up here. Going to advance the chart a little bit. I'm going to start advancing the chart. Walter, you always turn a good phrase there, my friend. He said he put it like this. I like this. You got to learn how to use the brakes before you can start learning how to use the gas pedal. That's a very, very good way to put that. Yeah, that's and right on the money too. Right on the money. All right, so let's go ahead and advance the chart and see what happens here. All right, so we come up here, we take out the top by just a little bit, but notice what happens here. We come down, you know, we don't quite take out this other swing up here. You see it? This other swing from the pre-market session. We can't even quite really get to that. So technically speaking, we're still really in the range. If you were buying support here with these little mid-band sort of kisses here, if you will, you know, if you're boxing in or using a line tool or something, some manner of getting in here, and you were long, and you took this out, you know, this is you know, you want to make a little extra money on a runner and stopped out of that. In here, in my view, would be appropriate to trade 1 or 2 contracts. And the way you do that is, if you're getting long from the bottom here, or shorting the top, you know, you put one on and your target is the other side of the range. So, you know, buying and target is up here, and then you get your stop up tight so you don't give it all back. If you have a second one on, I would probably not do more than 1 or 2 in here. So we pop up, we come back, we hold there, we come down to the bottom. Now notice what happens right here. Now keep in mind, we're only about 15 minutes into the trading session. So we're still in that, everybody knows, okay? So let me ask the question. In the first 45 minutes of trading, generally speaking, first 30 to 45 minutes, even hour, let's say between 6:30 and 7:30, do we necessarily have a directional bias? Yes or no? In that first hour. Directional bias meaning that we only allow boxes to go one way, or do we allow ourselves to trade both ways? Trade both ways or one direction? Both. Good. So let me answer this question, Mindy. And this is nothing, this is not a comment about the background colors. I know she asked something about the background colors, and does this mean trend changes? In the first hour of trading, I don't really pay too much attention to the background colors, to be honest with you. I mean, I kind of look at them. They do mean something. They tend to mean a little bit more when you're actually in a trend. But in that first hour, you kind of want to let markets swing both directions. You got to be ready to take longs and ready to take shorts. Okay? So we got to be able to be looking both ways, both directions. Now there's an exception to that, and I'm going to show you that in a minute. Now notice what happens here. We come down and we take this bottom out. We took the top out and we take the bottom out. And you're right, Mindy, some of you noticed that the background changes to red here. And it looks like we might be heading down. Now if we're going to head down, what should happen beyond this point? If we look beyond the right edge, and we're right here at 6:46, so 15, 16 minutes into trading, if in fact this was going to turn out to be a downtrend, what should happen beyond this right edge? What would we be looking for to occur? Just type in what your thoughts might be. Good. Perfect. A lot of comments to the effect of you should get some kind of retracements up to or around the mid-band. You should get a lower low or a lower high. Should retrace, roll over. Good. Some previous support areas become a resistance now. Good, Brian. Good, exactly. That's exactly what we're looking for. So let me do it to the other side before we proceed and explain what I mean by this. If in fact the break to the upside was going to manifest itself and turn into an actual bona fide uptrend, I think we all would agree that we would have this thrust up here, probably check or come close to, just like it did this upper swing from the pre-market here we had set on our charts. should pull back here, should hold a higher swing. Yes, hold a higher swing. And then this market should do something like this. Now, if it did that, I think we all would agree, and the background would stay green. You know, not turn not turn the other colors and start going the other way. That this would now be a trend to the upside, and we'd be looking for long trades. Yes. Now let's proceed with what happens here. All right, we come back up, and what are we doing right now on those yellow bars right there? For all you who just typed, all you in here tonight who said you're looking for retracements, what is it doing right now? There's a whole bunch of you typed that in, so I know what you're looking for, and that was the correct answer, by the way. You're looking for retracements, exactly. Now it's not quite the mid-band, but it's coming close to it. You're coming into the sweet spot of potential trading. It's thrusting up into the retracement area where you're looking for shorts. Perfect. So let me qualify something here. When I say not have a directional bias, what I'm referring to is when a market is not in a trend. Just to be clear about that. Okay, if you come up to a top, you come up to a bottom, or you're range bound, you tend to have very little or no bias. Now, when the market, and eventually it does, eventually markets are going to go into a trend at some point. And when they are in trends, that's when you assume a directional bias. So with that being said, based on what you see here, if you were to go ahead and use Object Trader to box this little area in right here, would you have a directional bias on this box, yes or no, and what would it be? Right here. Would you have a directional bias on that box? And if so, what would it be? Think about it for a second. Think about what you're looking at there. All right, good. Everybody has, well, okay, yes. Could continue down, short bias. Good. I would have a short bias on this box myself personally, simply because in this particular case, you know, it's like this box right here. It's almost exactly like this box right here. Back over to our earlier discussion of where we were talking about breaking out of the top of the range and how it might turn into an uptrend. Fact of the matter is, you could have actually boxed this in. I can't remember whether we did or not, with a bias to the upside, because the background is green. You have a higher high and a higher low, and we're thinking could quite possibly bip up to here and take that out. Same sort of thinking applies to this box right here. We're saying to ourselves, well, if in fact this is a lower high and a lower low, then it should roll over. Now, I'd be looking to start loading up here. So, Brian, your question, this is where I'm going to start looking to load up. I might not put the full 10 on, but I'll show you other places where I would and did. All right, so let's see what happens. Let's advance the chart. We come up. One other comment on this, on the directional bias to the downside, aside from the fact that we're getting lower highs and lower lows, and of course the background is red, and we're thinking rollover here, is that you could possibly get a little bip up into the mid-band and roll. So in other words, it might roll up here. You might be getting in just a little bit too early. It comes up, and NASDAQ does that too, right? NASDAQ is notorious for that. Coming just a little further than you expect, and you're looking for shorts, so you want that roll, and you don't want to get sucked into a long trade and then be forced to roll it and stop out to get short. And usually in the room we will try to help you. You know, we'll make comments about what we're doing, so it'll help you sort of make a decision in regards to those directional biases or not. Okay, so here we go. We're rolling over. We got filled short on one of these bars right here. Initial stop is up here. And if you put multiples on, multiples meaning more than 2, where would the first target be? Look at our trade setup. Where would the first target be located? Take a look at the chart. This is answering some of the questions that some of you had earlier. Because some of you asked about targets. Where are your targets at? How far out are your targets? So this is answering that question. Adam, yeah, your whatever your normal stop level for the instrument you trade, I usually go 12 ticks. And then I'm going to talk about what we do after it moves. So where's our target? Where's that first target at? Take a look at the chart. There's something should be jumping right off at the chart to you that you should see. Everybody should see this. Good. 17. Good, good, good. All right. So let's talk about this first pop here. This is what we normally in the room you hear referring to something to the effect of scalper target. So what scalper target means is that you look for some kind of swing close by. In this case, 17. And most of you are familiar with the term fade that swing. Fade that swing means you come just inside of it by at least 3 or 4 ticks, and that's where your target would be. So you're looking at a target, short target of somewhere around 18. So let's talk about how far down that is from our entry. Now you can study this on your, and you should, if you have the time, take the time on the instrument that you like to trade and look at the trade entries for the morning, and then look how far the initial pop of the trade, long or short, how many ticks that normally gives you. It's probably going to be somewhere between 4 and 10, with the sweet spot being at kind of in 6 to 8 tick range. So let's say you got filled at 20.50, and you're fading that bottom there, 17.50 or 18, so 20.50, 3 times 4 is 12. You probably want to go 8 or 10. Get out right there. So there's your target. You're going to find that most of the instruments exhibit similar price patterns from day to day. So if you typically get a pop of 12 ticks, you want to come inside that and put your target at 8. Just go ahead and set it up in OT. Well, that's what I'm trying to address here, Brian. I'm addressing that question. His question is this: would you go ahead and put it at 17 and fade it after you enter the market, or would you preset that in Object Trader? And I think I just answered that. Yeah. So in other words, if you know that when trades enter, you're generally going to see 12 ticks, you want to come inside that at least 3-4 ticks. So you're going to go ahead and set your first target at 8. Okay, now YM that might be 6. Excuse me, hold on one second, please. Okay. So it goes without saying that let's just pencil this out and see what happens. We come down, we hit it, we hit it, we hit it. By the way, I'm going to do a caveat here, and I rarely ever do this, but I'm going to go ahead and do it anyway. I know we have a cardinal rule to pretty much never buy or sell thrust moves. Now, if you notice what's happening down here, right down here at this support level, it's just sitting here. Now, as I recall, and here's what I want to say about this. If you're in the room looking at charts and you say, let's say you have NASDAQ and YM up, and NASDAQ's not moving, but YM is, or you look at the Russell. I do this all the time. I'll look at oil, I'll look at the Russell. Usually one of the 3 equities lead the others up or down. Occasionally, and very rarely, you will have divergence where one will be out of sync with the other 2. Like YM was doing its own thing. Now the other day NASDAQ was like running up and the other two were selling off. Occasionally that's going to happen. But if you notice, what happens when you have that divergence is normally the one that's divergent eventually comes back to become like the other ones, right? They eventually all come back together and get in sync. What you could do is you could box this in right here with a strictly downward bias only. And the reason I say that is that if and when it was to break and you missed this box, this would be an opportunity to participate in the trade. And the reason you don't allow the long side to be enabled is the fact of the matter is it could hold here and then go up here, and you don't want to be getting long, right? So this is a case where you would definitely want to have a directional bias. Okay. So what I'm saying explicitly is, for those of you who boxed in here and you got short, your initial target is 18 because the swing is at 17, and that's down about 10 ticks from your entry fill. Could already had that set in OT, so it popped. You're in the 8. You got it. You lock it down. Peel 1 off there if you're in 2. If you're in 4, peel 2 off. Right? You generally want to pull 25 to 30% of your open position off at the scalper target. That's what that means. So if you're in a 2, you're going to get out of 1. Like I said, okay, if you're in 4, you're going to get out of 2. If you have 6 or more, you can just get to 2 and then let the rest of them be runners. Now, it's very important to do this, and I'd say this in every single webinar. I know most or all of you are doing this already. You take your initial entry stop of 12 ticks, which would probably be sitting somewhere up in here. I'm not going to measure it out. I'm just guessing. It's probably going to have been up in here somewhere. Okay, we want to get that down, fairly quickly within 2 or 3 ticks of our entry. Now, Object Trader, you should position everything in OT to do this automatically for you. Okay, you don't have to be. Now, if you're manually doing it, then you have to do it yourself. So what happens here is if you pop down and you pop 1 out of your 2, then you just simply, an Object Trader automatically would do this, because you set that up with the I've shown that many times. Everybody knows how to do that, right? You set it up so it goes 2 ticks behind your entry, so you're sitting right there. Now you got a free trade. You got 8 in the book, and if it flips on you, get 2. If you started with 4 and you took 2 out, remember that you're moving the remaining stop on the other 2, so you got to keep 2 back, right? All right, so let's proceed. If you had taken this secondary box, you would have been filled short on this bar right here. And as I recall, I think Nazi, or it could have been YM, I can't remember all the details. There's so many different trades. One of the other markets had broken already. I think it was the Russell. Anybody remember that? Anyway, what I'm trying to say is that sometimes when markets are kind of holding up a little bit and you see that the other markets are ripping down, NASDAQ's just sitting right here and the other ones have dropped 20 ticks already, it's a pretty good bet. If you don't want to use the box, of course, you could just put a limit order here to take it when it breaks, or when it breaks, go ahead and enter with a market order. By hook or by crook, you're short from either here or here, right? All right, let's see what this thing turns into. All right, let's talk about trailing stops now. So now, when you move your initial 12-tick stop to 2 ticks back of your entry, now effectively what your initial stop has become is your trailing stop. Now, if you're going to participate in large moves early in the morning, you have to let the market do what we call wiggle around a little bit. Okay. Now, there's several areas that I watch, several things that I watch, and I'm going to outline them as such. And this is going to, if you watch tomorrow in the live room, and I'm trading an instrument that you're paying attention to, here's what you're going to see. And this is why I wanted to do this webinar, to help you see it at the same time that I do, is, can you see this stealth line right here? You see that stealth line right there? We've had that stealth line for, I don't know, 7, 8 years since we started. This thing's been around forever. And see how it tightly follows the price action as it moves? And then occasionally it will be broken by sometimes a wick or more of a candle. Let me see if I can show this a little better. Stand by. Chart's locking up on me a little bit here. I want to show you something important here in regards to trailing stops. And this is something that you can program into OT. Everybody knows that. Gary's shown it a million times. If you don't program in it, you do it manually, I'm going to explain it to you right now. Notice how in this little patch right here that the wicks of these candles more or less sort of penetrate through this stealth line, making it disappear temporarily. See that? And then once the downtrend resumes itself with this next thrust down, it reappears. So what I'm saying here, just to be explicitly clear about it, is that if you are using the stealth line as a trailing stop, that is probably some of the tightest stops you're going to get. And there are going to be occasions where the wicks of candles or closings of candles are going to wick you out. And if you feel the move is going to continue, then you simply have to re-enter. Okay? That is a trader who is taking a, and a lot of you do this already, I know. Let's say you got in here. Okay, you got in late, got in there. And you're out of your first trade, it wicks you out. Now you see it rolling over. You see it rolling over again. What could you do? Do a market order or limit order or do a quick little box on it, and then you'd be getting right back in here. Or even possibly this little break candle right here. Use Object Trader, put a line there, put a limit order there, jump in the market as it rolled. Anyway, you're back in the trade. So this is more of a scalper mentality. Now, if you leave your stops a little looser, I'm going to show you a couple of areas here that I like to watch. See this line right here? In between this line right here and the stealth and the midband and the midband itself, these tend to be what I call looser stops. So when you hear numbers called out and the market's moving, I want you to, if you can, and a lot of you trade this and actually use those numbers, and that's good. But one of the things a couple of things I'm trying to show you here real quick is that you can see a lot of these, the trails sort of setting up on your own chart because everything you need is right there. So sometimes I'll go, I'll say the tight stops here and the looser stops are up here. That's what I'm looking at. I'm looking at these in dynamically moving the stealth line, this line, and the midband. Now you got to realize this is the trade-off, okay? If you're going to allow a market to retrace all the way up into the midband, there are many, many cases where you could be giving back as much as 20 ticks. Yeah, GW, generally speaking, the stealth line appears when the thrusting part of the move occurs, yes. It tends to go away when it's flat and then reappear. When a little bit of a trend move starts to unfold. Yeah, so that's when stealth generally shows up. So you can go with a tighter stop posture where you're getting in and you're getting out, getting in and getting out. Sometimes I like to take my trailing stops and just kind of put it a little looser than the stealth, but not quite all the way up at the midband. So it's kind of floating up in here a little bit. So I'll be willing to give back 8, 9, 10, 12 ticks, realizing that in a big move I could get 90 or 80 or 100. Generally speaking, I'm not going to let it get all the way to the midband because by the time it gets up there, I would want to lock down some profits and then look to re-enter, right? Midband's where we like to get back in, right? All right, let's go ahead and play this out. Now, there are a couple of different ways to do this, okay? So I was talking about trailing stops. If you get deep retracements, and I don't do this, but Gary does, and he talks about this and shows this, is that on retracements like this, he can actually add to positions, right? When a market pulls up, so you're already short from here or you're short from way up here and you're trailing your stops, you can add. You can go ahead and put another contract on. If you got up here, you would have a blended average, but it would only pull it down into here. Everybody knows how that works, right? So let's say you left 2 on, and you're trailing the stop. You got out of 2 at the swing. you're trailing two, you're trailing two, trailing two, and then you go ahead and you add one on a little retrace here. You go ahead and bump another one in there. So now you have three, and the blended average is down here now. I don't personally do that. If you like to try to experiment with that, I strongly urge you do it in sim. Don't start adding contracts on your live account until you get a good feel how to do that, because here again it could flip on you and you can take a profitable trade and now it turns into a loss or not a profitable trade. So you got to be careful with that whole adding thing. Now the second way, or there are many ways to get out. Now let's suppose that you had more on. Let's suppose that you had 6 on. Talking about the multiples again. We peel our 2 here, right? We trail our stop on the 4. Now, in the room, you may hear something to the effect of, there's a lot of support down there in that 0450 area. If you're in multiples, look to peel. So in other words, you don't have to let all 4 ride the whole way down. You can do that. You can absolutely do that. And if you don't want to get involved with putting targets at swing levels, that's the easiest way to do it. Just let the thing ride. Just let it all ride out until you stop out. Now, another way to do it is if you see a swing on your chart, you've identified some swings, some pivot levels, whatever, or you hear a number called in the room, if it gets down into 450, look to peel some there. If you're still in 4 from up here or more than 2, and it pops down, you could put a buy to cover limit at that swing. And you might hear a comment to the effect of, look, it popped right through that 0450. Watch, you might get a little bit of a bounce there. And if you had a target there, so in other words, you still have 4 with a trailing stop here, but you go ahead and look to peel 1 off here, so you'd still have 3. So in other words, what you're doing now with the target approach is taking advantage of the thrust moves as they come to other support or resistance areas. Now, I don't want to make this too complicated. Is everybody following what I'm saying here? I don't want to, I wanted this to be as simple as possible, where you get a good feel on how to manage multiples without turning it into a complicated thing. Is everybody following what I'm doing here? How this works? How we get in, how we manage the initial targets, how we do the trailing stops, how you can peel off it, how you can add on some shallow retracements, and how you could peel at targets. Okay, that's what we're discussing here. Everybody following? Okay, good. All right, let's move on. Let's advance the chart. So now the market is just tanking. Okay, it's just ripping. It's not even coming back up to the midband at all. This is the most ideal condition for loading the boat. For those of you who are saying loading the boat, this is the kinds of moves you want in the morning to load the boat. So we get another pause here. We get another very, very shallow retracement here. You can see once again that the market just slightly penetrated the stealth line, taking it out temporarily with these 2 bars right here. And then immediately, or very shortly, within a couple of candles from this wick, the selling resumes. The red stealth comes back. Markets are stair-stepping down. We are trailing our stop in a very semi-loose manner. The wick of that candle might have got you. If you had the stealth tight stop, it definitely got you. I think I might have lost the cursor here. Backing up, moving this around back to where it was. Can everybody see the cursor now moving around? Right here, cursor moving, white cursor moving. Everybody see that now? Somebody said they couldn't see it. Okay, now you see it. Okay. All right, so what I was saying was this. For those of you with the tight stop posture, following more or less the stealth line, of course you can see that bar right there took you out, stopped you out. If you had the target here, of course you would have peeled 1 if you were in multiples. And it wicked up here, could have got you. Didn't quite get back to the midband, but rolled over and you could have re-entered as it came down through here. We talked about that. Limit order, market order, however you got in by hook or by crook, you're short again. So here again, this is more the scalper mentality. You're taking shorts, you're stopping out, you're re-entering. Taking shorts, stopping out, re-entering. Those of you with the looser stop posture, with the looser stops, you're kind of loosely trailing it down. Loosely trailing it down. So you're somewhere in between the mid-band and the stealth line. I use a mix, Marabella, depending on the instrument and what's going on in the market. A lot of this is all set up in my OT, but occasionally, if I didn't, have time to sort of get that all worked up, programmed ahead of time, I'll just go ahead and enter, and then start moving things around on the chart. Where I see the swings that I'm calling out. I'll go ahead and, if I'm in, say I got in 10 up here or 8, and I've peeled 2 and I'm trailing on 6, I'll go ahead and peel 1 or 2 more at a target, trail the rest on down, just like I'm describing, just exactly like I'm describing right now. Now, those of you with tight and loose stops on this final thrust into this area right here, the tight stop, no question about it, when it came through still, definitely stopped you out right there. So you're looking for re-entry. Even the looser stops up by this line got taken out. Even the looser stops got taken out. So now we're looking, what did it do right here? Let me blow this up. So given the fact that we have a powerful downtrend, and if you got stopped out, what kind of entry are we doing here? Is this load the boat? Is this a load the boat entry, or is this lighten the ship? What do you think? But keep in mind, you're right at 7 o'clock. So you've had a half an hour, and it's dropped. I don't know what I can't remember what this turned out to be. 24 down here to 98. So 90 ticks. Caution. We got really interesting. Now we got a mix of lighten it up, dip the toe only, caution, load the boat from Marabella. Now look, there's 2 ways to look at this. Okay, there's 2 ways to look at this. And here's how I would suggest a healthy way to look at it. If you were the trader over here who had participated in this large move with multiple contracts, and so with fallen 90 ticks, you're up, maybe you're close to over your goal, right? 80, 90 ticks is a lot big move, and it could chop around or could consolidate. However, on the other, if you have not participated in this, you missed it, some or all of it, and you're hardly up at all, then this is an opportunity to jump in and load it up. Now, here's the thing. That being said, when you enter this thing, you got to manage it, because many of you have wisely observed that on this kind of move, it could start to retrace, and you don't want to get bit. So if you load the boat in this case, for whatever reason you decided to do so, just keep a very tight stop on it. Where is our scalper target on the mid-band potential rollover short? Where is that target located? Take a look at what's going on in the chart. Take a quick sip of tea while you're looking at it. Where's the first target? We call scalper. ¿Dónde está el scalperio? I think somebody typed in Phantom. I don't know it would be Phantom. Phantom is really just to clarify something for some. I know, because sometimes the concept of Phantom can be a little confusing. I understand that. Phantom really comes into play when you have a very large trend move, okay, and you start to get a retrace. So let's say hypothetically, as you're typing in your targets, you had this huge massive sell-off, it comes up and it retraces all the way up at or near the outermost band and then rolls over and continues down short. That would be a phantom trade, just so everybody knows that. First time in the mid-band after a trend change. So what that means essentially is you've had a trend. It's looking like it might change. The trend is technically still down until a swing or this level is taken out. That's what a phantom would be. All right, most of you have wisely observed that the swing here is located at 95 3/4. You want to come 4 ticks within that, so your actual target's going to be right in here, right? We're fading it. All right, let's see what happens here. Comes up, hits the mid-band, box it in. We get filled short. So everybody's clear on that. I just want to be clear. So the decision whether to load the boat or not is partially based on what you have participated to this point. If you had caught some or all of this trade and you're nicely up, maybe $1,000 or more, and at or above your goal, well then by all means don't throw 10 contracts on there. You want to lighten the load. If you, on the other hand, almost missed this completely or just got maybe a couple $100 out of it and you really want to participate in the move, then go ahead and get into multiples right here. Because there's a strong likelihood that you're going to get continuation at least back on down to that swing. And you did right here. Right there. Most of you got that right. You're fading that 95 3/4 swing. So let's do some quick math and see if the numbers coincide with our last scalpy. Everybody understand what I'm saying there? I just want to be clear about the whole loading the boat issue on that mid-band kiss rollover. All right, so you're filled short here at 99 1/4, you know, roughly on that bar right there. And then the scalpy target's down here at 97, so 99, 3.5, 10. Right? You're going to see those numbers occur. I'll tell you what, if you just took, you know, half an hour or two, and you really studied your charts on the chosen instrument you like, and you really learned these patterns, you're going to see those patterns repeat over and over and over. Well, PW, I don't know if you missed it. That's what I'm saying. This is it, for those of you who did not catch this massive trade down, and you wanted to participate and make money off the next move, this would be a load the boat. This would be, excuse me, a load the boat point right here with a tight stop. Here's how you can protect yourself if you're loading the boat and learning to do it. Right in that region box is where you get short and load it up, PW, right there. If you got nervous, let's just say hypothetically you're practicing and you want to throw 6 on there to get the experience of doing it. And you get nervous because you see that it's like 6 times what you're used to. If you're used to 1 or 2, it's going to be like 3 to 6 times the movement. So if you're used to seeing a couple of $50, $100 moves, it's going to be like $500, $600 movement. Okay, so in the beginning when you start doing that, it's going to freak you out a little bit because the numbers are going to be so much bigger. And you might be concerned about a big loss occurring. Well, what you can do is this. See how it pops down and it doesn't quite get to these swings just yet, and it kind of does this little retrace here. So you're kind of in the money. You know, you're in the money, you're in the money, you're in the money, and then sort of you're not in the money. Isn't that where it makes you nervous? Isn't that where it makes you nervous? You see, you know, you're up 50, you're up 100, 200, you're up 150, it's looking good. All of a sudden, then the bar comes back up and you're at 0. Maybe you're down 25, 25, 20, 25, 50. Your entry's here, and here's your stop. Your stop is way up here. 12 ticks from your entry. So I don't know, what do we say? 99 1/4 plus 12 is 01. Yeah, I don't know. It's up here. It's up here somewhere. Depending on how large, 10, 12 ticks, whatever you put, it's sitting way up there. And when it's coming up like this, you're saying to yourself, oh my goodness, holy cow. Not only am I not going to get down here, but it's going to come all the way up here and I'm going to get creamed. I got 6 contracts, so I'm going to take a 12 tick hit. That's going to be horrible. I don't want that. PW, I'll circle back in a minute. Okay, I see your question. I'm not going to answer. I'll circle back towards the end and come back and nail that question for you, okay? Yeah, because we spent the better part of an hour dissecting this whole trade and what to do at the opening. Okay, you might have come in later, missed it, so I'll circle back and catch up on some of that. But I got to get through this first. We're almost out of time. In fact, technically we're out of time, but I'll keep going. All right, look, here's what you can do. All right, if you're really super nervous that you don't want to take this full hit, you know, come back, you know, cut it in half, come back, you know, 6 ticks back beyond your entry. Now the risk of this is that it'll wick up here, tag your 6 ticker, roll over, and drop 40 ticks, right? I mean, that's the whole reason you gave it some wiggle room. So bottom line, and this is a good lesson for everybody here when it comes to this whole multiple issue, is don't put the multiples on unless you're comfortable with the risk. You have to be able to put a trade on here and say, okay, you know, if it hits that 12 ticker with all 6 contracts, I'm okay with that, because you have sufficient capital in your trading account, you have good trading experience, and you feel comfortable with what you're doing. If you're sweating it, then you really need to stick with 1 or 2 contracts and keep your risk low until you build that confidence level up. Okay, that's really what it comes down to. So you can see here the multiple issue is not just, it's not a one-sided thing. There's a lot of, it's not complicated, but there's some moving parts to it. Everybody see that? There's some moving parts to it. All right. So anyway, yeah. So we do come down and we pop our 10 ticker, and then it keeps dropping, chops around a little bit here. You tight stoppy runners probably got wicked at somewhere in here. You know, if there's a target down here at 92, you got several chances to get out. Double bottom down near 92. You know, you could put a limit order down here and got taken out the second time down. Multiple ways to get out here. The trade actually turned out for multiples to go from here over to, in terms of your trailing stops, right over to here. Oh, for goodness sakes. There we go, like that. Now, what's it doing right now? Over here. For those of you who got stopped out, what's happening right there? Let me advance it a little bit more. How about right now? What's happening right now? Ah, mid-band. What are we looking for? Rollover. Good. Now here again, I want to qualify this for the whole load the boat issue, so we're clear again, right? If you participated in some or part of this and you made some coin and you loaded it up a little bit here and you made some good coin, you pulled off 2 here, maybe you put 4 on, you trailed the 2, got out, stopped out here, so you made a few hundred more bucks. Now you're looking pretty good. Take another bite at the apple right there. For those of you that missed everything, this is another load the boat opportunity. For those of you that are at or near your goal, go into sim. It's all money management when it comes to entries and re-entries. And it's all a function of what you did before that point. Everybody see that? You can't just say one roll and say, okay, at this box, load the boat. It doesn't work that way. It's all a function of what has happened to you prior to making the decision on how much leverage to take at any given point. All right, we box it in, it rolls over. I'm not going to ask you, everybody knows where the scalper target is. It's right there. We've done it several times. You know that you're going to scalp it when it gets down here, and to fade the swing, everybody knows that, right? Okay, and we break down, starts chopping around, and then it comes up and starts really whack-a-moling around. So now you're at about 720 and trading almost an hour. So this last trade didn't really turn into much. You know, you probably got stopped at down here depending on how tight your stops were. You know, so if you peel some in here and then ultimately you got stopped out again right there. All in all, some pretty good moves, right? All right, just to recap, let's go back. Any final questions? I'm going to get ready to lock her down. We went a little bit over. That's okay. PW, I think you missed earlier on. Walter, thanks for coming. Have a good evening, everybody. If you got to take off, if you want to stick around just a couple of more minutes, I'm going to take any final questions. Anything that was unclear, we talked about at the open, first of all, of NASDAQ, to resist the tendency to just jump right in. You got to let the market move around a little bit. We all know that. Give it a few minutes. usually within 5, 10, 15 minutes, certainly within the first half an hour to hour, you're going to get some moves. There's just going to be some moves. It'll break out of the chop and start moving. And that's what we got here. We got, depending on how you traded this range, you got a couple of long trades off the mid-band. Made you a little bit of money. This is not load the boat area in the range. Okay, we come down, we break down through the support, we come up, we roll over, we get several places to get in here, right? We talked about it. We talked about how to trail the stops. We talked about using targets to get out too at swings. We talked about how you could add on shallow retracements. And whether you like to get in and out. If you're getting in and out person, use the tight stops. Okay, if you want to just, if you're a person that just wants to be sort of a little more relaxed, not getting in and out and paying the commission fees, then you got to leave, leave the stops a little looser. We talked about that. You got to let the market wiggle around a little bit, and then eventually even the loose stops get stopped out, and then you got to look for re-entry. Okay, MG, thanks for coming, Brian. Yeah, you can set all that up, and Brian, I don't know if you had a chance to watch the Gary's Object Trader webinar. Okay, PW, thanks for coming. Jim, he has, and I think they're near the top of the subscriber login. Oh, and there was a question about the whole expiration thing. Let me try to come back and let me turn. You know what? I'll just let the recorder run. Hold on, because somebody else might want to, watching a recording of this, might want to learn how to do this. So, okay, all right. So what you want to do, David D, thanks for coming. I see people got to be taken off. I know it's late in some, it's 9 o'clock in some parts of the country there. All right, everybody should bookmark this webpage, cmegroup.com, cmegroup.com. Okay, you're going to go down here. The equity instruments are located. It's the exchange where the futures are traded, CME. Everybody knows that, Chicago. You're going to see right in here that the equities are located right here. So here's E-mini S&P, here's NASDAQ. They all roll at the same time. All these instruments roll at the same time. Here's the mid-cap 400, EMD, everybody sees them here. Okay, so let's just take, I don't know, YM. All right, so here's how you can tell what's going on ahead of time. Is you see that at some point we're going to roll from the June contract on not only all the equities are going to roll from June to September. Does everybody see that? June to September. Now you click on the June and you go to calendar right here, the last sort of toggle button here. All right. Can you see this last trade date right there? Now, generally, they're going to the brokers will send you a warning in your email that the June contract is about to expire. And generally they're going to fade that 17th date by a week. So they don't want any trading, beyond a week. Certainly by 3 or 4 days, they don't want to try to be clearing and covering any final trades right up to that last trade date. So that's why that's always faded by about a week. So around June 10th, you're going to get a notice to roll that contract into September. Now what's going to happen, you're going to notice, is this. Two things are going to happen when you get that notice. Of course, we'll be saying it in the room. Everybody, we'll be talking about it. It's not like it happens in the dark. You're going to notice a couple of things are going to start to happen. The volume will shift. See how you have 32 contracts and here's 4,000 contracts? The volume is going to shift from here to here. And then eventually June's going to fade away and go off the calendar, right? June will just go away eventually. And all the volume will come over here. Same thing in December. So here you can go down here in December, come over to the calendar, and you can see that the September contract is going to trade through the 16th of September. Generally, it's going to be that third week, somewhere in that third week of the month, of the expiration month. So notice all the dates are somewhere between like 15th and 18th. That's generally when they're going to be, and you fade it by a week. But you'll get notices, and you can always check on here. So you're looking probably on September 10th to roll to the December contract. Okay, that's how each quarterly roll on the equities happens. You can do that pretty much for any contract in here, anything you're trading. If you're trading something other than what we have in the room, a lot of you, I know a lot of folks trade gold. You know, gold's on here. Here's gold. You've got the notes and the bonds over here. You know, you've got crude oil. Here's crude oil right here. You know, we just rolled to July. Let's go ahead and look right here. Here's crude. Okay, you can see that all the volume now has shifted from the June contract over to the July contract. See that? So, you know, if you looked at this several days ago before the roll, it would look completely opposite. All the volume be up here and very little volume down there. Brian asking again about, okay, Mindy, thanks for coming. Have a good evening. Is that any more questions on the whole rollover thing? Everybody got that? CME group, you see where to go? You know, whatever instrument you're looking at there, just click on it, get you over to the calendar. It'll show you that last trade. The other way to do it is that when you're getting ready to roll and you go to your instrument manager, and you get to your instrument manager, it'll show the new date. When you go to populate, when the instrument manager, it'll show the new date. Yeah, so that's another way that kind of helps you out a little bit. Okay, I'm going to stop the recorder. Thanks.